Let's talk about this week's economic data.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDucTrading founder, Samantha LaDuc. For more information about Edge, visit www.LaDucTrading.com/edge.
Yeah. So I think when we spoke, it was last week on the more public call, I think you even brought up a tweet that I had put up about how oil was signaling maybe some more concerns about recession and a growth slowdown. But my concern for overall risk assets was going to be that I didn't think the Fed was going to react swiftly to that growth slowdown. And so I think as we kind of pass through this week, what I would say is that the data I think we're getting is showing more concern about this growth slowdown. We have, oil prices, we'll just start with that, have been really, getting hit very significantly despite the geopolitical stuff. I think it really suggests an oil market that is concerned about the demand outlook, particularly in Europe and in Asia, more so than specifically in the US. But nonetheless, in this geopolitical environment, to see oil breaking down to 4 or 5 month lows here, I think suggests a growth slowdown. Then, if you look at the labor data that we're starting to get, and you've been talking about this, for months, just about, the threshold on initial jobless claims. And so while we haven't hit, your threshold yet, we have seen, a couple weeks, 3-4 weeks in a row now of continuing claims, which are creeping higher. But more importantly, but I was even going to say, continuing claims have been have been up now. I think you're right. I think that's either, basically 7 or 8 weeks in a row, and are at basically now the highs for the year. So, look, we expected the labor data to show some deterioration, and it's happening. And I think even the Fed itself has been kind of talking about the need for the labor market to show better supply demand balance. And this would be expected, and we're getting it, but it's happening at a slow pace. So the slowdown is happening at a slow pace. The market is pricing in my view, a rapid slowdown that will be addressed quickly by the Fed with more liquidity. And what I mean by that is after this week's CPI, we could get into that a little bit in more detail, but the CPI coming in a touch lighter than expected kind of elicited a Fed is done forever on rate hikes approach, right?
Inflation, no rate hikes.
We are pricing in 0 hikes now for the rest of for the end of time, and we are pricing in a cutting cycle that begins, some people think at the March meeting, maybe by the May meeting, and at least 4 cuts next year. And I think that is a reasonably aggressive. And I think that what the market is missing is that while the inflation print did come in lighter than expected, there is really no evidence that inflation can sustainably get down to 2% yet, right? The Fed and supply chain alleviation has assisted inflation's drop from 9.8 to 3. And on headline, we're basically at 0 on month, and next month we may get a negative print if oil kind of stays here. But the core, which is driven by services, which are driven by wages, is still in the 4% camp. So we're twice the target, and so it just doesn't appear that we're going to get rapidly down to 2%. So I think in light of that, the Fed is unlikely to initiate this cutting cycle like the market is pricing in. And furthermore, there had been this discussion about financial conditions tightening as bond yields were moving north towards 5% in the middle of October into the end of October, and the equity market had been sliding and credit started to widen out a bit. Through the first 2.5 weeks of November, we've seen a 50-60 basis point move down in yields. Treasury, the long end has rallied immensely. NASDAQ is effectively making, very close to highs, I think, for the year again.
Gotta show you this chart.
So
Yeah.
financial conditions have eased significantly over the course of the last 3 weeks, which in my view means the Fed needs to not, engage in the Fed will not engage in this type of cutting cycle because they are not sure that inflation is going to come down. And there is a risk that animal spirits will reignite inflation expectations and we'll just be in this song and dance again. So all of that being said, I think the market has once again, third or fourth time this year, front run the Fed's reaction function in a very big way in a week where flows dominate. Right. We've talked about this ad nauseum about the time.
But it is a thing.
It is. And I know, I think I've been saying this every month now, but it is the biggest thing.
Yeah.
It is the biggest thing. The flow. I mean, even, the zero data expiry flows and the sell vol flows they overwhelm every other flow in the market. And on days where vol is elevated, let's say into the CPI print like it was, it doesn't even really matter what the print is. They're just going to sell vol afterwards. And the reaction was immense to what didn't seem like a fundamentally, extraordinarily weak print.
The full episode is available to all Edge paid subscribers. Visit www.LaDucTrading.com/edge for more information.